Here again with Smart System. In our last lesson, we began our discussion on trading journals, where they look at how traders leverage these to learn from their past successes and mistakes. In today's lesson, we're going to continue our discussion on trading journals with a look at what successful traders look for when reviewing their trading journals. So let's get started. Simply writing the trading day's activity down in your trading journal is the first step towards leveraging that journal to help you improve on your trading in the future. The next and equally important step is to review your trading journal on a regular basis to see what is working and what is not. This way you can leverage your journal to help you improve in areas where you're weak and make sure you continue to leverage your strengths where you're strong. There's a great article from Dr. Brett Steinbarger at TraderFeed.com, which addresses some of the major things that trader should analyze when reviewing their trading journal. The first thing that he mentions here is the number of long and short trades, which, if you remember from our last lesson, is one of the things that we recommend documenting in your trading journal. He correlates this to the trend conditions of the market to see whether he's trading with the current trend or against it. So basically what he's looking at here is if the market's in an uptrend or a longer term uptrend and he has a lot of short trades, then that's probably a bad sign, because that means he's trading against the trend in the market. Similarly, if there is a range-bound market conditions during the time of the trades he's looking at in his journal and he has allocated much more of his positions towards one side of the market, and that would probably indicate that he's missing out on a lot of opportunities or not seeing the range as well as he should. Because in a range you should sort of have equal amount of long and short trades, or approximately equal amount of long versus short trades. The second is the number of winning and losing trades, which we also recommend documenting there. And for his particular strategy, he says when he's trading well, he has more winning trades than losers by a reasonably healthy margin. That is true for most short-term traders. But if you remember from some of our previous lessons, that does not necessarily have to be the case. You can have more losing trades than winning and still be profitable. In many longer-term trend trading strategies do. So I think the key thing here is to realize what the ratio of winning to losing trade should look like for your strategy. And if your trade journal shows that you're deviating from that ratio significantly, having more losing trades than your strategy should expect, then that's something that you need to take a look at and reevaluate. The third thing is the time and trades. He says he's a short-term trader, and so he obviously has a relatively narrow time band in which to hold trades. If he moves beyond this, from looking at his trading journal, if he sees that he's moving beyond these relatively short holding times, then he says he's either cutting trade short or going for home runs, and neither of those have worked for him well in the past. There should be again here. If you're a longer-term trader, you're noticing that your trades are getting shorter and shorter, or that your trades are getting longer and longer, then that's something that you should probably address, outside of what you would normally expect from your strategy. Fourth thing is the time holding winners versus losers. And I think this is probably true with pretty much any type of strategy. If you are in your losers a lot longer than you're in your winners, that's pretty much recipe for a disaster. You definitely want to be cutting your losses short, and that means not only from a loss in terms of dollars but also in terms of time and the lost opportunity that you have. When you're holding on to losing positions there, the profit and loss break down by long and short and market condition. So this basically tells Dr. Steinbarger and pretty much anybody who looks at this type of thing in their trading journal, whether they're trading better in range bound market conditions, whether they're trading better in trending conditions, whether trading better from the long side or short side of the market. I would add to this two additional things. The first here would be the average profit and average loss for each trade, and that gives a good quick look at whether I'm cutting my losses short and letting my profits run. And then number two is the largest loss suffered on the account before returning to profitability. That's also known as the maximum drawdown. And this is a number that I want to know, because most traders have a certain number that they're comfortable with and that a certain number that they should expect from their strategy. And if you get below that number, whether it's 20% or 30% drawdown or loss on the account, then it probably is showing that there's something wrong with the strategy that you are trading. And all of these things, if you document the things from our last lesson, you could do it manually. But as I pointed out in our last lesson, if you get to know Excel a little bit, there's very easy ways to automate the process of looking at a lot of these things through some very pretty simple formulas there. So I'd encourage you to do that. So that completes our lesson for today. In our next lesson, we're going to look at how to run or think of trading like a business, with a look at how to develop a trading business plan. So we hope to see you in that lesson. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with your trading. Have a great day.